Good morning, everybody, and welcome to our second installment in our three-part webinar on liability management transactions. I'm Anthony Canale, Covenant Review's Global Head of Research, and I'm joined today by my colleague Scott Josefsberg, Covenant Review's U.S. Head of High Yield Research, as well as my colleague Ian Feng, who's a Senior Director with the U.S. Leveraged Loans team and the author of our quarterly series on U.S. liability management transactions. So in today's installment, we're going to be discussing drop-down transactions. And in our third episode, we will be focused on double dips and other LMT transactions. And that episode will also include a guest appearance by Dan Kamensky of the Creditors' Rights Coalition. For those of you who missed our first installment of the webinar on up-tiering that we presented last week, don't worry because that episode is currently available on YouTube. You can find a brief summary of that episode, as well as a link to the video and the slides on the CreditSights website. Finally, a little bit of housekeeping that the slides for this presentation will be made available for our audience after this presentation. So let's kick things off with discussing what a liability management transaction is, a brief recap of this, which we also covered last week. So there is no real formal definition to what is a liability management transaction, but at Covenant Review, we generally consider an LMT to be a transaction by a distressed borrower or an issuer that utilizes existing or amended contract terms to manage long-term corporate debt liabilities with some creative out-of-court solutions. So this can end up significantly affecting the creditor rights, collateral pools, and recovering values as the capital structure moves around and various instruments get primed or moved from a better position to a worse position. But ultimately, there's no formal definition. And if you talk to a number of senior leverage finance lawyers, you'll get different definitions of what they think a liability management transaction is. Ian, can you speak to this chart a little bit?
Yeah, so this is a chart from our latest quarterly report on liability management transactions, and it just demonstrates the increasing prevalence of LMTs generally. If you go back far enough, it does look like there's only one or two, and that's probably more of a historical artifact in that the term liability management transaction didn't really come into play until, let's say, 2020. Prior to that, we called it things like out-of-court restructurings, debt, the ratings agency called them distressed debt exchanges. There were many types of transactions that maybe today we would consider LMTs, but back then they were just not known as such. And that includes what we're talking about today, the J.Crew transaction. But the major trend is really, post-2020, a significant number of those kinds of transactions that are universally understood to be LMEs or LMTs, things like drop downs, up tiers, double dips, those really came into their own post-2020, post-COVID, and that trend has been increasing every year since 2022, or actually 2021. And we're on track to exceed last year's 47, which was itself a high watermark. We expect to see a number of LMTs between now and the end of the year, and certainly into next year as well.
So that brings us to the next slide, which is discussing common types of liability management transactions. And in our first type of transaction, the up-tier transactions, also known as pulling a CERTA, we discussed those at length last week. Those generally involve exchanging existing debt or layering of existing debt with a higher priority debt with credit support from largely the same assets. We discussed that, as I mentioned, last week in our first installment of the webinar. All of that is now available on YouTube. In our second type of LMT transaction is the drop-down transaction. That's what this presentation is mostly focused on. And what a drop-down transaction involves, and it's commonly referred to as pulling a J.Crew, that involves dropping assets down into a structurally senior entity in connection with incurring new, better debt at that entity or other transactions. One thing to note historically, while people are focused on the J.Crew drop-down transaction, J.Crew itself is not the first instance of a drop-down transaction. In fact, about 10 years ago, in December of 2015, iHeart Communications moved 100 million shares of its Clear Channel Outdoor subsidiary into an unrestricted sub as a prelude to some coercive LME attempts with its creditors. Those attempts ultimately failed, and we won't go into the history of that. But if for people looking for a more historical example of a J.Crew that precedes J.Crew, that research is all available on our website. The third version of liability management transactions that we're going to discuss in this series is the idea of the double dip and pari plus transaction, also popularized by At Home. And generally, the idea with this liability management transaction is to create multiple recovery claims in respect of the same dollar of new financing. So creating separate looks at different pools of assets, or in At Home, two distinct looks at the same pool of assets in respect of the same dollar of financing. And then you have this category of miscellaneous, which is generally a combination. It could be a combination of one or more of the above transactions, as well as other creative structures. Scott, do you want to take this slide?
Sure. Thanks, Tony. So an overview of how drop-down transactions work, and as Tony mentioned, this is usually referred to as pulling a J.Crew. The general idea is that collateral is stripped from the borrower or the issuer and moved into a non-guarantor entity, usually an unrestricted subsidiary, and then structurally senior debt is issued out of that non-guarantor entity, usually for the purpose of refinancing junior debt, as happened in the original J.Crew transaction. So two things are going on there. One is you're taking assets that were originally in the guarantor group and you're moving them into a non-guarantor, like I said, usually an unrestricted sub, and then issuing new debt. And this trick works because of structural seniority. Now structural seniority is vis-a-vis the existing debt at the borrower or issuer. Now, in the last session, when we were talking about up-tiering or CERTA transactions, we talked about up-tiering working because of lien priority and payment priority. So basically, there are three main flavors of subordination. And like we talked about with the CERTA up-tiering transaction, there's payment subordination, which means one debt is senior to the other in right of payment. There's lien subordination, meaning one debt is senior to the other on the collateral. And now here we're talking about structural subordination, which I think is the most difficult conceptually to grasp. So structural subordination, as the name implies, arises because of the structure. So if we look at this picture we have on the right hand side of the slide, we have an unrestricted subsidiary, which is a non-guarantor. And then on the far right, we also have non-guarantor restricted subsidiaries. They're non-guarantors all the same. And so they don't guarantee the debt of the borrower or the issuer. And if you put debt on one of those non-guarantor entities, creditors to that non-guarantor entity have a direct debt claim against that entity. And so that direct debt claim must be satisfied. Creditors can enforce directly against that box, and that direct debt claim must be satisfied before any residual equity value can flow up from that non-guarantor to the borrower in order to satisfy any claims, any debt claims against the borrower or the issuer. So because those creditors have a direct debt claim against the non-guarantor entity, we say that debt is structurally senior. Or put conversely, the debt of the borrower entity is structurally subordinated to the new debt of the non-guarantor. So usually this happens with an unrestricted subsidiary. And when we get to the next slide, Ian's going to talk about the J.Crew Trapdoor a little bit. But for the most part, the J.Crew Trapdoor is not necessary. The real enabling provision for these kinds of drop-down transactions are the scope of investment capacity. And when we talk about investment capacity today, that's really just code or lingo for diverting assets to unrestricted subs. And that's not the way that it's always been, right? J.Crew and drop-down transactions really were not enabled because things in documents changed necessarily. These kind of transactions were enabled because largely sponsor and issuers changed the way they think about unrestricted subsidiaries. The original idea was supposed to be, these are some small pockets of value for where it makes sense to do things outside of the credit, outside of the strictures of the restrictive covenants, like if, for example, the issuer wanted to do a joint venture in China or something like that. And these were supposed to be limited pockets of value for that kind of thing. But the quantum of investment capacity has expanded, and the view on what investment capacity in unrestricted subsidiaries can be used for has changed very much since J.Crew. Now, unrestricted subsidiary investment capacity is largely viewed as just pockets of value that sponsors and issuers can do whatever they want with, including returning value to equity, refinancing junior debt, and all kinds of liability management exercises. So the idea is we have to look at all of the investment capacity, accumulate all of the baskets, and that's the potential scope for a drop-down transaction. An issuer can use all that capacity to move valuable assets into an unrestricted subsidiary. An unrestricted subsidiary is not a guarantor. If there was a restricted subsidiary guarantor that was holding those assets that's designated as an unrestricted sub, the designation would automatically release the guarantees and collateral granted by that entity. So what we're really focusing on, there are a couple other things on the list here of enabling provisions, but what we're really focused on is the quantum of investments capacity. That's what enables a drop-down type transaction. Why don't we flip to the next slide? And Ian, if you want to talk to us a little bit about the trapdoor.
Sure. And before we go on to that, just to talk about the term investment, it's not what you think it means. The term investment, I think in common parlance would be, oh, I'm investing in something, I expect something in return. That's the point of an investment, right? Whereas investment as defined in these debt documents can often be quite a bit broader. It can include things like acquisitions of new businesses. It can include guarantees. What we're really worried about is when it includes this concept of a asset transfer or capital contribution to a particular subsidiary. And there have been some court cases where essentially the court says actually determined investment does not need to have any sort of expectation of a return. There is no profit motive behind it. It can be a purely structural change in terms of where assets are sitting within the company. And that's an investment because effectively that's how it's defined in these indentures and credit agreements. So let's take a little
jump in with one more point. Sorry to cut you off. I could just jump in with one more point quickly. The only other thing I'd like to point out is to Ian's point of investment being so broad, a lot of the times we think about the drop-down transaction as the J.Crew prototype where they invested material intellectual property into an unrestricted sub. But we should note that there's no reason that a drop-down or J.Crew style transaction has to be limited to IP. That was the prototype because those were the valuable assets in that credit. But there's nothing in the investment definition that would require it to be IP. There's nothing special about IP that made that work, just to the extent there's investment capacity. And like Ian said, it's a very, very broad concept. They could move any valuable assets into an unrestricted sub and do this structurally senior debt trick. Sorry again for cutting you off, Ian. Please go ahead.
No worries. I mean, IP is often thought of as sort of the key asset to transfer, in part because it's reasonably easy to transfer. There's some paperwork involved, but it's a relatively simple process of filing with the USPTO or US Copyright Office, and you're on your way, right? Whereas some other assets might be a little bit more complicated, but we'll get into that. But let's first take a trip back in time, back to the halcyon days of 2016, before COVID, before all these things happening in the world today. It was a simpler time. It was a more innocent time, I would like to think. And then by the end of the year, we got J.Crew. So what was J.Crew? Well, J.Crew was a drop-down, like we've said, but it was specifically a drop-down that used a particular mechanic. And I think the problem with J.Crew, at least vis-a-vis the market, is that the market at the time fixated a little bit too much on the mechanic and not on the underlying problem, which is, as we said, investments capacity. And the mechanic is something called the J.Crew Trapdoor. And the trapdoor is really two different carve-outs in the investments covenant of J.Crew's credit agreement. And I've put them in this slide here. The first one is in 702T, and it says investments made by any restricted subsidiary that is not a loan party, to the extent such investments are financed with the proceeds received by such restricted subsidiary from an investment in such restricted subsidiary made pursuant to blah, blah, blah. What does that mean? Well, it basically means that if you have an entity within your restricted group, and I'm going to just go back a second to the prior slide, within this dashed line, we have the medium blue color of borrower issuer, and then the two light blue ones of guarantor restricted subs and then non-guarantor restricted subs. And we're talking about the non-guarantor restricted subsidiaries. So these are entities that are within the restricted group, meaning that they are subject to the negative covenants. They are supposed to comply with the limitations imposed by negative covenants, affirmative covenants, and other terms in the credit agreement or indenture. However, they are not providing direct credit support. That means they are not guaranteeing the debt of the borrower or issuer, and they are not providing collateral support. They are not pledging their assets. Now, in most high yield, broadly syndicated loan deals, the universe of guarantors consists of wholly owned, material, domestic, that is, those entities formed in the US, restricted subsidiaries. So who's a non-guarantor restricted subsidiary? Well, usually that would be anyone who's not wholly owned, anyone who's immaterial, and anyone who is foreign, which in this case means outside of the United States. There's a couple other standard exceptions, but those are the big ones. So in the J.Crew basket, let me just go forward again, you'll see 702T is talking about those non-guarantor restricted subsidiaries, and it's saying that, well, they are allowed to make investments as long as that investment was financed by another carve-out, specifically these three, 702C4, IB, or N. You can ignore IB or N. They're not relevant to this discussion. So we go to 702C4, and that's our intercompany investments basket. And that basket's talking about investments, again, within that dashed line, within the restricted group. And C4 says that loan parties can invest in, again, non-guarantor, non-loan party restricted subsidiaries up to the greater of 150 million and 4% of total assets. So if you combine these two baskets, what happens? Well, if you can follow the line of reasoning, you start at 702C4, you move $150 million of assets into a non-loan party restricted subsidiary, and then 702T says that non-loan party restricted subsidiary can invest in anyone else because it was financed by that original 150. In other words, you take 702C4, which was supposed to be a limited basket for investments by loan parties in non-guarantor restricted subsidiaries, and you turn it into a general purpose basket, which essentially says that you can invest in anybody so long as you pass it through that non-guarantor restricted subsidiary. And so the market's reaction to this was, well, that's silly and crazy. We're not going to allow for the trapdoor anymore. And that has happened, right? The reaction to J.Crew at the time was a broad rejection of this so-called trapdoor flexibility. You still see it on occasion, but for the most part, the trapdoor is functionally extinct. What's interesting about J.Crew, and we said that J.Crew was not the first dropdown, and that's absolutely the case. It was not the first transaction where value was moved from the restricted group or the loan parties into an unrestricted subsidiary. What I do think J.Crew represents is a turning point in how we view liability management transactions generally, and specifically in how we view sponsors and borrowers and issuers approach towards LMEs or LMTs. And that's because if you look at these two carve-outs, it doesn't really make any sense, right? From a logical standpoint, why wouldn't you just create a $150 million general basket if the intention is another general purpose carve-out? Why do you need to go through this artificial step of transferring it through a non-guarantor restricted subsidiary, which in J.Crew was essentially a Cayman holdco that they just formed? It was an empty box. It had no assets. It had no operations. Its sole purpose was to serve as a pass-through entity for this IP. Why would you do that? Well, if you think about 702T, it had a reason behind it, and it was really meant to do things like prevent double counting. It was designed to prevent someone from a company who may want to use a pass-through entity from having that investment counted twice, because you don't want to count it twice. It's essentially one transaction, just count it once. And that's what 702T was supposed to do. The problem is that it included this intercompany investments carve-out, and I can guarantee you it was probably some junior associate at 3 a.m. trying to draft this thing, and they made a mistake. And as a result, this language is in the doc, and it works from a purely textual standpoint, but it doesn't make any logical sense. And at the time, Covenant Review and others said, well, there is this loophole. It exists. Someone could use it. But I think most of the market thought, well, I don't think anyone is going to use it because it's silly and the result is absurd. And J.Crew showed us that no, sponsors and borrowers will utilize language in their documents, even if it doesn't make any logical sense, so long as there is a reasonable interpretation of the text to back that interpretation, right? To back that transaction. They will take advantage of loopholes. They will take advantage of those nits in their document in a way that will be detrimental to the lenders. And if you see J.Crew as sort of that starting point where companies are no longer relying on sort of the plain text capacity of their documents, but really relying on loopholes and exceptions, I do think J.Crew is something of a watershed moment as far as distressed debt exchanges are concerned. Let's go to the next slide. Scott, you want to take this one?
Sure, I can jump in here. Thanks, Ian. So to the point Ian made about these carve-outs making no sense, there's a version of the trapdoor that goes even further that we like to refer to as the black hole. So what's happening here is that there were a number of documents that had this flaw contemporaneously with J.Crew, just like this pass-through carve-out that Ian referred to as in the J.Crew loans. It was in a lot of high-yield bond forms for other TPG-sponsored companies. Although I don't think we saw anybody make use of the black hole in the egregious way that J.Crew made use of the trapdoor. This was a flaw that was there and potentially could be used. And so the difference was we have the pass-through basket, and on the slide it's permitted investments clause number 25 that we show. But instead of pairing that with a limited basket for investments in non-guarantor restricted subsidiaries, we're pairing that with what we often refer to as the free flow of value problem. So this occurs in loans sometimes, but is largely a high yield problem. And if we go back to the history of high yield bonds as unsecured instruments, it makes a little bit of sense. It's not great, but it makes a little bit of sense. And the idea being that permitted investments, almost always permitted investments clause number 1, allows for this free flow of value. And what we mean by that is unlimited investments within the restricted group. And that includes non-guarantor restricted subsidiaries. So if you're in an unsecured instrument, and like I said, the history of unsecured bonds is they're mostly unsecured, something like 70% of high yield bonds are still unsecured. If you move an asset from a guarantor to a non-guarantor, that's not great, but you're not losing collateral because they're unsecured instruments anyway. But if you put these two together, it creates on a textual base, if you just read the text, it creates unlimited capacity for investments in unrestricted subsidiaries in a similar two-step process to what J.Crew did. First step is permitted investments clause number 1 allows the company or any guarantors to invest an unlimited amount in non-guarantor restricted subs. So that's step 1. And then step 2, under this permitted investments clause 25, which is the J.Crew trapdoor, any non-guarantor restricted sub is allowed to pass through any investment made in that into an unrestricted subsidiary. So you put those two together, and that means in two-step transactions, an unlimited amount of assets can flow through from the guarantor group to non-guarantor restricted subsidiaries, then to unrestricted subsidiaries. So even worse than the original J.Crew, right? Like we said, the J.Crew transaction was relying on a $150 million basket for investments in non-guarantor restricted subs. Wasn't supposed to be allowed for unrestricted subs, but when you paired it with the Trapdoor, it could pass through to unrestricted subs. So instead of a cap basket, we have high yield bonds having an unlimited basket for investments in non-guarantor restricted subs. And paired with the J.Crew Trapdoor, this creates unlimited capacity, and that's why we call it the black hole. An unlimited amount of assets can be stripped from the guarantor group, removed from the collateral, put into unrestricted subs, and leading to structurally senior debt on those unrestricted subs.
Yeah, and Scott, I would just call attention to the fact that, again, because J.Crew trapdoors are for the most part not present in most leveraged loan and high yield bond indentures today anyway, does that mean this problem is not there? And the exact black hole problem isn't there, but I think it's worth talking about the free flow of value as a problem in and of itself. By allowing transfers within the restricted group without limitation, you do open up a lot of, I think, opportunity for abuse, right? Because J.Crew transactions, drop-down transactions, we always talk about it in the context of unrestricted subsidiaries, but you can use other entities. You can use non-guarantor restricted subsidiaries as sort of the endpoint of your drop-down. Put the value into a non-guarantor restricted subsidiary. That non-guarantor restricted subsidiary can issue debt, and that debt will also be structurally senior. The limitation, of course, is that non-guarantor restricted subsidiary is still subject to the covenants, and so the amount of debt is going to be somewhat more limited as a result. But given the state of covenants today, that isn't always that comforting to most investors. Often non-guarantor debt capacity is significant, if not as significant as any other debt capacity that's available under the debt and liens carve-outs. So if you're going to allow for free flow of value, and it essentially says you can move an unlimited amount of assets into a non-guarantor restricted subsidiary, what would stop the company from, let's say, transferring all or substantially all of its assets into a Cayman holdco or some foreign subsidiary, or even a entity that is partially owned by, let's say, the sponsor and the company, so it's technically non-wholly owned? You could, in theory, move all of those assets into that non-guarantor restricted subsidiary via this free flow of value. And if you have a lot of debt capacity, you could still issue a lot of structurally senior debt as a result. And to touch on the amendments problem, in many amendments, sections of credit agreements and indentures, there will be a limitation saying that you cannot release all or substantially all collateral. Unfortunately, there's often a carve out there that says other than as permitted under the credit agreement or other than as permitted under the indenture. What does that mean? It means that if you have this free flow of value carve out, that means that transfer is permitted. And so the limitation in the amendment section technically would not apply.
You know, it's a good point, Ian, that you can do a drop down transaction with any non-guarantor entity, restricted subsidiary or unrestricted subsidiary. And just to put a finer point on that, I think it's worth pointing out for folks who are a little new to this stuff that unrestricted subsidiaries and restricted subsidiaries are really artificial designations that exist solely for the purpose of the credit documents. They're subsidiaries of the company all the same. The only difference is unrestricted subsidiaries are not subject to the covenants and restricted subsidiaries are. If you have a non-guarantor restricted sub, like Ian was saying, you can functionally accomplish the same thing. Debt at a non-guarantor is structurally senior, and whether it's restricted sub or unrestricted sub, for that point, doesn't really matter.
One point I wanted to make briefly before we go to market responses on this is that when we've been talking about the drop down, we've talked about this LME in the context of moving assets, dropping it down into largely an unrestricted sub, sometimes a non-guarantor restricted sub, with the idea that the next step is then new priming debt at that unrestricted sub that's currency for a coercive exchange. I did want to note briefly that we have seen instances where the drop-down transaction was done for other purposes that didn't involve new debt incurred at that subsidiary. For example, we've seen creative sponsors take the position that you could try to move assets to an unrestricted sub in the context of an asset sale or a transaction that otherwise would be an asset sale. The asset sale covenant of an indenture or a credit agreement generally provides that if there's a defined asset sale, you have to do certain things with the proceeds and you have to meet certain requirements of the asset sale covenant. Well, the idea is, hey, if we drop these assets down into an unrestricted subsidiary and the unrestricted subsidiary does something, sells those assets, well, then the asset sale covenant doesn't apply, or definitely doesn't apply for the bonds, may or may not apply for the loans, depending on how the language is written. So this is another technique that we've seen the drop down used. We've seen it in at least 2 instances historically. We call it round tripping, where you move assets into an unrestricted sub, you sell the assets out of the unrestricted sub, you move the cash back into the credit, and voila, the asset sale covenant magically doesn't apply, or at least that's the position taken. So again, most of the time it's in connection with structurally senior new debt, but there are variations on that theme in very creative ways that sponsors and their counsel have been able to structure around other covenants in the indenture or credit agreement.
Yeah, and Tony, I would also add another variation would be the spin. Unrestricted subsidiaries can often be spun off under the RP covenant without limitation, essentially. You don't need to use up things like builder capacity or general basket capacity, because there's often a carve out allowing for the transfer of unrestricted subsidiary debt and equity to an equity holder without using other carve outs. In fact, that's what Neiman Marcus did back in 2018. They designated their My Teresa business, which was one of their online businesses, I think in Germany. It was doing relatively well compared to the rest of the business. They made it unrestricted, and then they transferred it so that it sat directly below an affiliate of the sponsor, Ares, which is functionally the same thing as a spinoff. And it takes away the value of My Teresa or of that unrestricted subsidiary from existing creditors. In fact, they don't even have an indirect claim anymore. They don't have a claim at all. They're essentially sister companies with My Teresa, and they use that whole mechanic as essentially a carrot to bring creditors back to the table so they could negotiate another LME essentially later that year. And of course, it didn't really work out for them. I think they filed for bankruptcy a few months later. So how has the market responded? Well, we talked a little bit about some responses, one of which was to eliminate the J.Crew Trapdoor. But again, the Trapdoor is just one carve out. It's not really the underlying issue. In fact, in J.Crew, it did nothing but contribute $150 million of additional capacity. And I think the value of the IP transfer was around $400 million. So it was just a portion of that overall capacity, but it wasn't the underlying issue. Instead, the market's response has been, I think, more narrow than has been helpful. The main response has been the implementation of blocker provision, and specifically something called the J.Crew blocker. Now, conceptually, the J.Crew blocker is designed to prohibit transactions like J.Crew's by prohibiting the transfer of a specific type of asset to unrestricted subsidiaries. The response, however, was the way that a former colleague of mine used to call it. He called it a whack-a-mole response. And it's because the response was designed to address the last LME, which in this case was the transfer of material IP. So what do most J.Crew blockers look like today? They look like a prohibition on the transfer of material IP to unrestricted subsidiaries. The problem, however, is that's often a bit of a knee-jerk reaction. In J.Crew, material IP or IP in general was particularly important. And that's because of the way that capital structure looked, right? There was a term loan, a standalone ABL with a crossing lien, and then there was some holdco PIK debt. And the term loan and the ABL, because the ABL has a first lien on all the stuff that you associate with J.Crew, things like inventory, all the clothes, receivables, all of those revolving lenders, they get that stuff first. What do the term loan lenders get? Well, they technically get everything else, but what is that? Well, there's a lot of stores. So is there real estate there? Not here, because J.Crew mostly leased their stores, and leaseholds were carved out from collateral. So what was left? Well, it was the J.Crew name. It was the brand name of J.Crew and the value associated with that name. That was most important to term loan lenders. And so the transfer of IP in J.Crew was particularly problematic and particularly important to the lenders, or specifically the term loan lenders, in that deal. Now, is IP always the most important asset? Absolutely not. And yet the market's response has been to say, the J.Crew blocker is going to prohibit transfers of material IP, even if IP is not particularly important to the business at hand, which essentially guts the protection provided by the blocker in the first place. If you're blocking the company from transferring something they don't have, that doesn't do anything. Some deals might try to be a little bit more expansive and just say any material assets. Obviously, that would be a better response. And on a post-LME basis, that's usually what we see instead. But unfortunately, new issue documents in both the high yield market and leverage loans will continue to use this more limited J.Crew blocker, which only prohibits transfers of IP. Now, what if IP is important? Well, unfortunately, J.Crew blockers are also in the hands of lawyers, and lawyers are going to find ways to draft these things to create additional carve-outs, additional exceptions, additional loopholes. One of those is to limit the transfer so that it's only by a subset of parties. So instead of having a prohibition on transfer of material IP to unrestricted subsidiaries, it's a prohibition by loan parties or guarantors of material IP to unrestricted subsidiaries. That means you can transfer things to non-guarantor restricted subsidiaries without limitation, or at least without the limitation of the blocker. And those non-guarantor restricted subsidiaries can, again, transfer on to unrestricted subsidiaries. So it's almost like a repeat or a new variation on that two-step process that J.Crew made famous in the first place. Another way to limit it is to limit the blocker so that it only applies upon designation. So when you create an unrestricted subsidiary, you are designating them as unrestricted. And at that moment in time, the company is required to comply with a number of conditions. If you set the blocker so that it only prohibits the designation of entities that hold material IP or material assets, that would mean that you could create an unrestricted subsidiary that does not hold those assets, and then the next day start transferring those assets to that unrestricted subsidiary because it's no longer at designation. It is just using existing investments capacity. So this is all to say that there's a J.Crew blocker. It is in most new issue deals, and yet it is often flawed or weak, or there are going to be ways around it if the company really is looking for those loopholes. The next blocker is called a pluralsight blocker. This is essentially just a variant on J.Crew. It's named after a LME that happened last summer for a company called Pluralsight. This was actually in the private credit market. So it was one of the first LMEs that we saw in the private credit market. And it was similar to J.Crew, a transfer of IP, but in this case, it was a transfer to, like we said, non-guarantor restricted subsidiaries. So the market's response has been to try to impose a pluralsight blocker, which does the same thing as J.Crew blocker, except it says you can't transfer to non-guarantor restricted subsidiaries. So ideally, you could have some combination of both kinds of blockers, and ideally, it would extend to beyond the just material IP, but to material assets in general. But for the most part, pluralsight blockers are quite a bit rarer than J.Crew blockers. Now, the next two responses are ones that unfortunately have not really seen a lot of uptake, at least in the broadly syndicated loan market and high yield market. The simplest response, and probably the best response, would be simply to remove the ability to designate unrestricted subsidiaries. If you can remove unrestricted subsidiaries or the ability to designate them, then you lose the ability to transfer value to them. You lose the ability to spin them off. You can't do this round tripping through asset sales. A lot of that becomes a non-starter. Unfortunately, I think it's also a non-starter for this to ever really become part of the broader market. You will see the removal of unrestricted subsidiary flexibility in post-LME documentation. So really distressed company already. Lenders have already done a LME and they want to prevent a future LME or a future drop down. So they'll take the step to remove unrestricted subsidiaries from the credit agreement as a whole. But as far as new issue documents are concerned, that's just not going to be something I think that will gain a lot of traction. I certainly would not advise syndicate members to try to argue to get rid of unrestricted subsidiaries during syndication. It's just not going to happen. However, you could do something a little bit more narrowly focused, which is you could limit the amount of value that could leak into unrestricted subsidiaries. And there's two ways of doing this. You could certainly try to negotiate smaller baskets on every individual carve out. That's theoretically possible, although probably not very practical, especially in the fast-moving process of marketing and syndication of both term loans and bonds. The more simple approach would be to impose a global cap. And so a global cap functions as a total limitation on the amount of value that might leak into an unrestricted subsidiary or even a non-guarantor restricted subsidiary. Tony, you actually wrote an article about this a few months back on how global overrides can be a very useful tool to limit borrower and sponsor overreach. And the way it works is you have to think about how negative covenants work generally, right? Negative covenants work as a broad prohibition or a primary rule against doing something. In this case, let's say it's the investments covenant, thou shalt not invest, full stop. And then you have 30 or 40 carve-outs and exceptions and baskets. The global override would essentially override those carve-outs and exceptions and say, even if we gave you $1 billion of capacity through these baskets, we're going to say you can do no more than X amount on investments in unrestricted subsidiaries. And that would create the most clarity for, I think, most investors. They'd be able to look at that global cap and actually understand how much capacity can go into unrestricted subsidiaries. If it's drafted correctly, you don't have to worry about loopholes. You don't have to worry about these two-step processes that create more capacity than you expected. The global cap would certainly take care of that. Again, the problem, it's just not a thing in the large cap, broadly syndicated loan market or high yield indentures. You do see it, however, in private credit on a fairly regular basis.
I would just add to that where the time pressures are intense with these documents to turn around something and get comments in, and most deals, you're right, to your point, are never going to accept an override provision like this. But in the event that a deal is struggling, it is a far better solution for the document to just say, notwithstanding the foregoing, you can't put X amount in an unrestricted sub or a non-guarantor restricted sub or what have you, versus trying, because if you're trying to go through and negotiate all of these carve-outs, you're dead in the water. You don't have enough time to do that. And the lawyers are always going to be more clever than somebody trying to negotiate these carve-outs. So yes, a quick and dirty override provision strategically inserted into the document is a winner if you can get it. And to your point, there's very low uptake of that in the market.
That's right. A couple of relevant questions here. One, do you see the global cap applied to non-guarantor restricted subs? Not very often. Even in private credit, that's not very common. But theoretically, you could. I've definitely seen it. It's not unheard of, but it's just less common. When it comes to non-guarantor restricted subs, there are other ways to attack that problem as well. You can have a more limited capacity for debt issuances out of that non-guarantor, for example. Another question is, please, can you explain the upon designation point again? Absolutely. So the blocker can be drafted a number of ways. It can be drafted sort of as a universal rule where you cannot transfer, let's say, material IP at any time to any unrestricted subsidiary. And you can draft this any number of ways. You can say it as unrestricted subsidiaries are simply not allowed to own material IP, or if they acquire a material IP, they must be redesignated as restricted. You can do all those things, but it's essentially a rule that applies at all times. You can also have a blocker, however, that is only tested once. And in many cases, it's upon designation. So to go back to Scott's point about unrestricted subsidiaries being an artificial construct, in order to create an unrestricted subsidiary, there needs to be a mechanism within the credit agreement or indenture allowing for the creation of that unrestricted subsidiary. And that creation is often called a designation. You, the borrower, affirmatively designate an existing subsidiary as unrestricted. And you can set it up so that the blocker only applies or is only tested when you do that designation. So it'll say something along the lines of, the company may not designate a subsidiary as unrestricted if that subsidiary at the time of designation owns material IP. So if you have an existing subsidiary and it has all of your material IP, that subsidiary cannot be designated as unrestricted. What that means, however, is that you could create, let's say, again, an empty box. Let's use the Cayman Islands again. It's a Cayman holdco. It has no assets. It has no operations. It does not own material IP. You are allowed to designate that entity as unrestricted and won't even use up investments capacity because that empty box has no value. Because the tests or the blocker is only tested upon designation, that means in the future, you can start transferring the IP to that newly designated unrestricted subsidiary because at the time of designation, it did not own material IP, but it can acquire material IP in the future. That is not prohibited.
Hey, if I could jump in and put a finer point on that. What's going on there is that there is arguably a legal distinction between what is a designation under the documents, under the credit agreement or indenture, and what is a transfer. And to Ian's point, designation happens. You say this subsidiary exists, we're designating it on day one. Transfer happens later. You can transfer assets into an unrestricted subsidiary. Both of them are deemed to be investments. Both of them need investments capacity, but they happen at different times. The designation is, we have a restricted subsidiary. We're going to call that from now. Henceforth, you are an unrestricted subsidiary. That's a designation. Transfer is moving assets later. And we've seen some situations where that has really made a difference, and sponsors and issuers have really taken the view that designation and transfers are legally distinct concepts. So when we flip to the next slide, Ian's going to talk to us about some additional examples of dropdowns, but one of them on the list is Envision. And Envision did a dropdown with its AmSurge business. And now what happened there was there wasn't what I would call specifically a J.Crew blocker, but there was a deal-specific negotiated point that said any transfer of AmSurge must comply with these delineated requirements, and they generally required paying back debt in a waterfall that made sense. But those requirements specifically said any transfer of AmSurge must comply with these requirements. And the issuer and the sponsor took the view that that's only transfer. If we designate AmSurge as an unrestricted subsidiary, we haven't transferred anything. We don't have to pay down any debt. We don't have to comply with this very clearly deal-specific negotiated provision because it used the word transfer. And when we designated AmSurge as an unrestricted sub, we didn't transfer anything to anybody, and so that was allowed despite the clear prohibition.
So this last slide just gives some examples of LMEs that had a drop-down component. I would highly recommend those of you who do subscribe to CreditSights and Covenant Review. We have a comprehensive list of LMEs in our quarterly report. It's downloadable as a separate Excel file where we do tag any such LMEs that have a drop-down component. It's not listed here, but one aspect of drop-downs that is sometimes missed, I think, is the idea that actually securitizations can be a form of drop-down as well. Because you're transferring the receivables to a special purpose entity. That special purpose entity usually is not required to become a guarantor, so it's a non-guarantor. It may be unrestricted as well. The issuance of that debt, structurally senior. So things like ABS financings, securitizations, those can function as a drop-down LME depending on the context. And we've seen that a number of times, including Team Health as well as Frontier Communications That was with fiber assets. And so that's become a major issue, especially with the communication sector, on whether or not you could do essentially a drop down of your fiber assets via securitization. And the answer is often, yes, you can. It's often uncapped.
One other point about this slide first is that there are several transactions you'll see on this list where a drop down is used in connection with other LMTs, whether it's a drop down with some double dip aspects or an up tiering aspect. So it's not there aren't mutually exclusive remedies as we saw, or mutually exclusive structures. The second point is kind of a bigger deal point on Envision that Scott mentioned before. Envision was one of those deals when it came to market that included, at the time, was a new development for high yield that said you didn't have to incur $1 of ratio debt to draw basket build capacity. And typically up until that point, until Refinitiv and Envision, there was a requirement in high yield that you'd be able to incur $1 of ratio debt pro forma as kind of a proxy for solvency. The idea that you have to be able to do ratio debt under the debt covenant if you're going to take out basket build capacity. Refinitiv eliminated it, and Envision followed right behind it and also eliminated it. Obviously, with Refinitiv, those bondholders did fine. They got the make whole. Everything was great. Envision had all of this capacity built in by virtue of this transaction feature, and was able to use that in the LME that followed. So another example of how innovations and stuff that works its way into documents often is being put there to create optionality that can be used on the back end against you. And let's see. Do we have any additional questions that we want to?
Yeah, just to jump here with a question from the audience. Somebody asked if a designation would be limited by the scope of investments capacity. The answer to that question is clearly yes. Whether we're moving assets into an unrestricted subsidiary via a designation of an existing sub as unrestricted, or transfer assets later, those are all deemed to be investments under the indenture or credit agreement. So if, for example, there is an existing restricted subsidiary that has valuable assets, for that restricted subsidiary to be designated as an unrestricted subsidiary, the issuer would be required to have investments capacity equal to the fair market value of that subsidiary. So to the extent the assets are there already, investments capacity equal to that value is required. Ian used the example a couple times of designating an empty box. That would require no or de minimis investment capacity because there are no assets there. But then when assets are transferred in, as assets are transferred to the unrestricted subsidiary, the issuer would again require investments capacity equal to the fair market value of the assets being transferred. Either way, for assets to move from the restricted group to the unrestricted group, investments capacity equal to the fair market value of the assets are required.
Okay, there's a question here. What establishes whether a non-guarantor subsidiary is restricted or unrestricted when a bond or loan is brought to market? It is going to depend on the deal, and it is a negotiated point. The default rule is that everyone's restricted on day one. Everyone in the group, so the borrower or issuer and all of its material, wholly owned domestic subsidiaries are restricted unless the company elects to designate them as unrestricted in the future. Now, you can have day one unsubs. That is a negotiated point. If the company already has a bunch of entities that has some sort of operation where it makes sense to separate them out from the rest of the group, they may have those entities as unrestricted on day one. That would not use up investments capacity because you're agreeing to it from the get-go. One thing to note about unrestricted subsidiaries, however, it's not all upside for the company. When you designate or you have unrestricted subsidiaries, that often means that they are not counted for purposes of financial calculations. So the way that financial calculations work, so leverage ratios, EBITDA calculations, all of those things, they're usually limited to the restricted group. So it's the EBITDA of the borrower and its restricted subsidiaries, which means that if you designate an entity as unrestricted, it can have a negative impact on EBITDA because you're essentially carving out that EBITDA that was attributable to the unrestricted subsidiary. It can also be positive, however, if that subsidiary that you designated had a bunch of debt, because now you're not counting the debt either. But it is a negotiated point of whether or not you're going to have unrestricted subsidiaries on day one. Ideally, that would be disclosed in the schedule, but not always, of course. Another question is, do you have an example of a deal where covenants were airtight in protecting against the dropdown, or will there always be a loophole somewhere in the docs? I'm a pretty cynical person, so I'm going to say there's always a loophole somewhere. That said, there are documents that are more protective than others. It's usually more of a spectrum than a yes or no, especially on post-LME documents, after the LME has happened. Those creditors negotiate very hard for better protections, and you'll often see those docs to be the tightest. And it's also why pre and post LME covenant scores will differ so significantly in terms of how protective they are. The post LME, of course, is going to protect those creditors way more than the pre LME will. Are they ever going to be airtight? I hate to say ever airtight, because there's always going to be something that you can find. These are 250, 300, 350, even 400-page documents. You can sneak something in if you need to.
I do think that we do see sometimes provisions that are pretty good at providing some protection that I think means the company has to come to the table. I know we talked about iHeart before. When iHeart filed for bankruptcy after years of liability management and some really creative arguments, when they emerged, the first two bonds that were issued, the senior 27s and the secureds, those bonds had pretty decent J.Crew protection, and it was material assets. I think there was language in the designation provision. There was also an override provision in the permitted investments definition. So you could try to come up with some theoretical arguments around it, but I thought that there was actually pretty decent protection, and it was no doubt informed by the history of that credit prior to when it filed for bankruptcy. And I think that ultimately in the LME that was structured, they had buy-in from both the TLB and all the two series of bonds that had that protection. So again, was it foolproof? It probably wasn't airtight. And if we gave Ian a couple of hours with it, he could have found a way around it. But I think that the protection was strong enough to necessitate that the company come back to those creditors.
And our covenant score is definitely take into account leakage capacity and drop down flexibility, and we do try to flag that as a primary aspect of our covenant scores.
So it looks like we are about at time. So I wanted to take a moment to thank everybody for participating in today's webinar episode. And we're looking forward to seeing you all in our third and final installment, which we'll be doing a week from today. And we'll be taking a closer look at double dip, pari plus, and other liability management transaction structures. This episode will also include a guest appearance by Dan Kamensky of the Creditors' Rights Coalition, and we're looking forward to seeing you all then. Thank you so much for your time today.